First of a kind sectors are really tough because they have a broad set of market failures, which make it really difficult for even the most successful projects to flourish in those kind of systems. There's one really important overlooked factor in first of a kind projects. The teams behind these projects face a breadth of development challenges that standard projects don't typically face. Supply chains that don't exist, commercial offtake contracts which don't have a precedent, financing structures which are not fit for purpose, regulatory frameworks which are incomplete. These are kind of gaps that are beyond even the best founder teams to manage. It would be an absolute shame that in 10 years, if another fuel crisis comes along, like we're seeing now, and we're in a situation where we're so vulnerable with 90% of our fuel imported. I would like to see in 10 years' time that we really are on a pathway to our own domestic fuel security. Project gets a bit of momentum and then it gets stuck. And it gets stuck and it spends most of its time trying to fundraise. And then finally gets going again and gets going again. And that turns like a 3 to 4 year cycle into, a 10-year cycle.
Welcome to Before It Scales, the podcast about first-of-a-kind clean energy and industrial projects, the people building them and what it takes to get them across the line. I'm Joy, a principal here at Cyan Ventures. Before we begin, we'd like to acknowledge the traditional owners of the lands on which we are recording today and the traditional owners of the lands on which you are listening. We pay our respects to elders past, present and future and extend that respect to all Aboriginal and Torres Strait Islander peoples. Now, together with Mission Possible Partnership, we are tracking the development of Australia's low-carbon liquid fuel projects, representing around $19 billion of announced capital. Between them, they could supply something like 17% of our aviation fuel demand, but not one of them has reached financial close. So, in June, Cyan Ventures launched the Green Fuels Accelerator, funded by ARENA and supported by Qantas, Boeing, Mission Possible Partnership, Climate Tech Partners, and various other organizations to work with 7 projects on common commercialization problems, preventing them from getting to financial close. So my guest today is our very own Dr. Fraser Thompson, managing partner here at Cyan Ventures. And for a bit of background on Fraser, he co-founded ThumbCable. He spent 9 years at McKinsey, including leading McKinsey's Global Institute on Sustainability. And he chairs the Low Carbon Fuels Alliance in Australia and New Zealand, amongst many, 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 many other things. Fraser also leads our Green Fuels Accelerator. So let's get into it. Fraser, welcome. And the low carbon liquid fuels projects that we're tracking currently represent $19 billion of announced CapEx. And not one has reached financial close, as I mentioned in the intro. Why is this? What is the background here?
Thanks, Joy, for having me today. Look, I'm an economist at heart, and I often discuss things from the point of a market failure. Now, I know as soon as someone mentions market failure, half our audience tends to turn off in boredom, but stay with me for a second. So first of a kind sectors are really tough because they have a broad set of market failures, which make it really difficult for even the most successful projects to flourish in those kind of systems. And low carbon liquid fuels is no different. There are market failures in 2 really important areas, which are the roadblocks today. The first one is the lack of a clear demand signal. We've done surveys of investors, off-takers, project developers, and it's clear that the number one issue that they face is this lack of a clear market signal for demand. Now, if you look at what's underpinning that challenge, there are a number of market failures. One is that we're not pricing externalities. Such as the carbon emissions. So there's no sort of automatic sort of equality, if you like, between the emissions generated by fossil fuels versus those lower carbon alternative fuels. And that makes it really challenging when these fuels are 2 to 6 times as expensive as those fossil fuels. So pricing externalities is important, but it's not sufficient in its own to bridge that gap with fossil fuels. The other market failure related to this is the failure to take into account learning curves. Like, learning curves are really important across a whole range of clean industry. We all know the story of solar and batteries and Wright's law about how the cost came down with scale. The same thing will happen in green industry, such as low carbon liquid fuels. But to get that learning curve kickstarted, someone needs to underpin those first projects, and that's a real challenge. What airline or what off-taker is going to put themselves out there to pay that kind of price premium if others are not going to follow? And then the third market failure related to demand is that we fail to price really important other benefits that low carbon fuels provide. Fuel security is one. The crisis in the Strait of Hormuz has rammed home the fact that we don't have a domestic industry, and 90% of our fuels are imported here in Australia. But there's also other factors that we don't consider as much. So take, tourism risk. We know that in the US, like almost 40% of US corporate travel bookings now flag the importance of using sustainable fuels in their bookings. So imagine just if 1% of travelers did not travel to, say, Australia because of concerns about their carbon footprint. This impact is huge and would more than offset any costs. So these kind of market failures are not pricing externalities, not taking into account learning curves, and not taking into account the non-monetary benefits really underpin this lack of a demand signal. But there are things being put in place. So we have regulatory frameworks being put around the world around mandates and standards that try to level the playing field and give real clarity to low carbon fuel demand. And currently about 65% of global fuel use is in countries which are implementing or about to implement such schemes. And here in Australia, our own consultation on a low carbon fuel demand mechanism is also about to kick off. So that's an important piece of this. I know I've spent a fair bit of time on it, but it's important. I think I just want to address one sort of myth as before we leave this topic, is that many people said, well, it's 2 to 6 times as expensive. This is going to be such a knock-on for consumers, and we're never going to be able to travel again. Now, this is not true. The great thing about green fuels is that you can blend it. And so basically, when it's more expensive at the start of that learning curve, you can blend less of it with fossil fuel in the same tank. And then as it gets more competitive, you can increase that blend. So even at, like, say, a 5% blend of low carbon fuel, it would cost on average less than a cup of coffee for a one-way trip for most flight destinations across Australia. So not a really big concern factor from costs. The second really big bottleneck is around access to capital. Now, again, this could be its own podcast, but there are no reference projects for these first of a kind projects. And these makes it really hard for investors, whether they're debt or equity, to understand the risk and how to fund these projects. From an economist standpoint, I would say this is an information failure. And if you look at how these projects have been funded in the past, it was through corporate balance sheets of the incumbents. But, waiting for the oil majors to pivot into the sector, it reminds me of the Samuel Beckett play, Waiting for Godot. We'll be waiting a long, long time if we're waiting for these incumbents to take the lead. So we need to find alternative mechanisms to fast track this to ensure the climate and fuel security risks we face. And if, we could go into this for a lot of detail, but just to give you a sense at the moment of the landscape, a typical low carbon liquid fuel project can take anywhere from about $30 to $50 million of development capital to reach final investment decision. And typically this capital is too large and project specific for venture capital, but it's too early and too risky for infrastructure investors, superannuation funds, and other lenders. So there's a real gap in this space. Arena fills some of that gap with, the grants, but they themselves require co-funding, and there is still this really important equity gap at the moment. So this is a key issue and something that we're looking into at the moment with different players about how we could address. And then when you get to financial close, you also have, additional need to de-risk some of the risks that are faced. So things like contingency risk from the lack of reference projects or technology insurance gaps. So in summary, the two core issues which are preventing our really impressive pipeline of projects from reaching reality are demand and this access to capital. If we can unlock those two issues, then there's no reason why Australia can't be a green fuel superpower.
And we've been doing, as you mentioned, a lot of work on this at the moment. And there's a version of the story. I mean, we've just heard offtake and demand is the biggest thing. So there's a version of the story where the answer is just simply a policy change, like putting in place a mandate, for example. But there's more to it than that. The policy won't fix this alone. So could you say a little bit more about that?
Yeah, look, I think innovative policy approaches are necessary but not sufficient to close this commercialization gap. There's one really important overlooked factor in first-of-a-kind projects, in that the teams behind these projects face a breadth of development challenges that standard projects don't typically face. This includes supply chains that don't exist, commercial offtake contracts which don't have a precedent, financing structures which are not fit for purpose, regulatory frameworks which are incomplete. These are kind of gaps that are beyond even the best founder teams to manage. And this is why we need additional support for these projects to help them get to financial close. And if you like, that's at the heart of our Green Fuels Accelerator. Take really promising projects and give them the support to help them manage this broad array of first-of-a-kind challenges that they must face to get to financial close.
And maybe to push on this a teeny bit more, our own survey work with Mission Possible Partnership, where we survey many of these projects, puts offtake as the number one challenge developers face and mandates or quotas as the number one intervention they actually want to see. So if those are the number one things that the projects want to see, how much can our advisory program actually move the needle for them?
Yeah, look, a policy signal is definitely important, but a project still needs support in the who and the how. On the who, it can be challenging for a project to fully understand the market dynamics across low carbon fuels. Who are the off-takers, whether it's around aviation, maritime, road freight, what are their price points, what are their buying criteria, etc. And as a result, what happens is that projects tend to generally focus on a very small segment of the market and are not properly monetizing their product. And then the second piece of that is the how. So even if you know who to engage, there's a real question mark around, what does a good offtake contract look like? Often we see projects that spend a lot of time and say, great, I've got letters of intent, I've got short form contracts, I'm good, I'm ready to go to financial close, only for them to go to equity and debt sponsors who say, no, sorry, that's not good enough. Those contracts don't meet the standard that we're willing to put capital against. They may not have the right kind of tenure, they might not have the right kind of counterparty risk, or there may be penalty clauses or some other factors which make them uncomfortable. So we need to find a bridge that gap. So that's our real supplement, if you like, to a policy signal.
And we're actually tracking a range of clean industry sectors, of which low carbon liquid fuels is just one. So why are we picking low carbon liquid fuels to focus on first?
Yeah, for me, there's three really important reasons for why low carbon fuels are exciting, particularly from an Australian standpoint. The first is that we often go where there's a clear demand signal. So first question, is there a market for this? And the great thing is that even though this market is nascent, there is clear regulatory underpinnings that are driving demand into this. And if you look, globally, sustainable aviation fuel, just one segment of the market, is forecast to be over $500 billion per annum by 2050. In Australia, research by Deloitte and the Clean Energy Finance Corporation has shown that our domestic demand could be around 36 billion Australian dollars by 2050. So really big, important markets. The second part of this is that Australia's competitive positioning. We really should be the global leader in green fuels. When you consider the kind of building blocks of competitiveness in this area, land, we have a huge amount of land, particularly marginal degraded land, which is something we need to figure out how we bring that more into the production mix. We have a strong logistics. Often, if you look at our fuel tankers, they drop fuel off and they return empty. So there's a ready means of transport that exists for us to transport our fuels. And we also have really sizable domestic demand. And that's through a combination of factors. Our aviation, Melbourne to Sydney is one of the busiest airline routes in the world. We also have significant road freight, and we also have significant off-grid demand, such as in mining. We're looking for decarbonisation solutions. So we have this sort of unique set of ingredients. And then the last piece is, how do we manage the green premium? In some sectors, this can be really hard, but in low carbon fuels, because we can blend the fuel, it makes that management of the green premium a lot easier. As I talked about earlier, if you're just doing a 5% blend of fuels, the cost impact is relatively negligible. And this is really crucial because it means we can kickstart that learning curve without requiring a huge impact on costs.
And I suppose the fuel crisis and the fuel security issue doesn't hurt right now in trying to build this industry in Australia, right?
Yeah, it doesn't. People have said, great, this is the silver bullet to unlocking this sector. I wish it was that simple. Unfortunately, I think we tend to have short memories, and my concern is that once this crisis abates, that we will quickly forget about some of the fuel security issues until we come to the next crisis. So yes, I think it is helpful for the time being. The really key thing for us is how do we take this wake up call and really make sure we shift it into something permanent, so we're not back here in the next crisis with the same set of issues.
Has it affected the impact of the green premium at all?
It's hard to say because prices have been moving up and down like yo-yos. So, and it depends on what element you're looking at. So diesel costs and aviation fuel, they've been particularly vulnerable to the crisis due to the mix of fuels that are coming through the Strait of Hormuz. And at some point, that green premium really got significantly reduced. But these markets are so volatile and so nascent that they're moving up and down very quickly. So, yes, in the short term, it's having some kind of impact. I don't think necessarily I'd overstate the importance of this shifting the price dynamics going forward.
Okay, let's talk about the actual program, how it works. So starting from a developer's perspective, if I'm a developer in this cohort, what does it look like for me?
Our starting point is to really get a detailed perspective of where the project sits from the perspective of investors. So we've developed a tool, what we call a finance readiness assessment. And you can think of this toolkit as a way that gives a holistic understanding of the project's development progress, its investment strengths, and its risks. And we also have our own, if you like, mock investment readiness committee, which is able to give perspectives of senior investment professionals around how they would view this project. So it's really kind of a unique set of insights and capabilities that we can bring to really help a project understand where they're at and what they need to do. And this is important because many projects don't often get told the detailed feedback that they should be getting from investors. And sometimes it's out of politeness that investors will say, look, no, it's not quite the right time for us, which may be code for them not telling around specific concerns that they had. Or other times is that investors just don't have the time to do really detailed due diligence on these projects. So we're trying to fill that market gap, that market failure, by providing a really detailed tool, but it's still practical to implement, that allows the projects to understand exactly where they are and what the priorities they need to move on to unlock that next stage of capital. And it all starts there because the bandwidth of teams is always limited. So you need to always think about, where are we focusing our time and effort? What's the key unlock that's going to help this project progress?
And in terms of the support that the projects will actually get, what are the artifacts that they're going to end up holding at the end of the program?
Yep. So we have a range of different end products, and this is all based around what the needs are of the project. So it could be around, some projects have looked for support in offtake contracting templates. So what does a really good offtake contract look like? Others have looked for support on IMs and investor teaser documents. And I guess the important thing to stress here is that this is not just us doing it by ourselves. We've got a range of really wonderful experts that are coming with us to support us on this project. And I don't have time to go through all of them, but just to give you some examples, we've got Natalie Lonergan, who's from Mills Oakley. And Natalie is a lawyer who's been responsible for developing the legal contracts and many of the most advanced offtake discussions in the US. So she's been in the trenches of understanding what are the legal terms that tend to create hiccups and issues for lenders down the track. And so having her experience and understanding what that can mean in the Australian context is wonderful. We've got Oliver Yates, who's the former CEO of the Clean Energy Finance Corporation, and Oliver's heading our mock investment readiness committee, helping to provide really detailed feedback to projects ahead of time to guide their actions. So these are the kind of unique capabilities and access to expertise that we think will really benefit Australian projects.
And how will it be delivered across the 8-month or so time period?
So look, most of our work is project specific. So really working hand in hand with those projects to understand where they're at and what targeted support we can provide. But we will be providing a range of knowledge sharing documents because we want these insights to benefit the broader ecosystem. So we have some webinars, so including some webinars that are coming up later in August, one on offtake, one on financing. And we'll also be producing some knowledge documents for ARENA around offtake and financing approaches that we'll release at the end of this program pilot. So we're hopeful that in addition to the benefits we're giving our 7 projects, we'll also get some knowledge that can benefit the broader ecosystem.
Yes, awesome. And on the webinars, I think this is going to be published in between the 2 webinars that we're doing. So anyone listening will be able to sign up to the investor one, which is at the end of August. But the offtake one would have already happened. So I presume we'll be able to share that somehow or have a recording of it for folks to listen to if they are interested. On the partners, let's talk a bit more about them. You've already sort of started to go into that. And I think what's something that's quite unique about this project is the passion involved from all of the individuals. Like everybody wants to see this succeed. But maybe let's go through them in order. ARENA is the most important partner here. They've provided the funding. Why do you think this is important to them?
Well, look, I can't answer for ARENA, but what I can say is that we're really thankful for the strong support that they've provided. And obviously, everyone who knows ARENA knows their role in R&D commercialization funding. But I think it's really interesting that ARENA, with this holistic view that they have on the ecosystem, has realized that there's still this gap. Darren Miller, who's the CEO of ARENA, had this quote at our media launch, which I thought was instructive. And he said, what's needed now is the support to help promising projects navigate the final steps to commercial scale. And I think that's where we come in. And as on an issue that's unique to low carbon fuels, it's across a range of green industry sectors from green iron to ammonia. But it's how do we go from that promising project that's had R&D funding to take it the rest of the way through to financial close. And I think this has been a real kind of blind spot that we've had, is that we think that the key is just to get these projects from the lab into some kind of concept, and then the projects will take it the rest of the way. Now, that may be true with some other forms of technology, but these first of a kind sectors, that's simply not true. There is a huge valley of death to navigate for these projects, where they need to address everything from regulatory permitting to offtake to financing to supply chains to technology engineering, a whole breadth of issues, which are really, really challenging. And that's where we come in, is to try to provide that bridge and that support to maximize the probability that these projects will reach financial close and hopefully increase the speed as well.
And the other supporting partners that we have in the mix include Qantas and Boeing, Mission Possible Partnership, Climate Tech Partners, and a few others. What does each bring and why are they involved?
So we're very fortunate to have these quality of partners with us on this effort, and they provide a range of different expertise, from thinking about offtake to engineering or technology concerns to how to think about financing structures or insights that we've seen from overseas that we could be adopting here. So it really does vary, but we're very thankful for all of that different expertise that we can draw upon as needed. And I'd say that's a point to emphasize, is that we don't come in with a preconceived notion of what these projects are going to need. We use that diagnostic exercise, that finance readiness assessment, really to properly understand the issues and where support would be useful and agree up with the projects. And then we draw upon our different experts and partners to help us bring that expertise to life. So that's why we have such a really deep bench of experts, is to try to cover the full gamut of potential support areas, whether it's around regulatory certification or offtake or financing, and we can bring that expertise to the projects.
An obvious tension in having an airline in the room while the developer talks about that offtake gap, because a partner is also a potential counterparty. How are we managing that tension?
Yeah, look, we're obviously very mindful of this. A starting point is that all the information shared by the projects is confidential. We have all the things like data rooms, secure data protocols, etc. And this is just part of the good governance hygiene. Having said that, though, is that there is still real scope for us to share benefits and learnings within these groups without causing any particular concerns. And what we've found actually in the program so far is it's pretty easy to actually put in the right kind of safeguards and ring fences that we don't have any of those concerns, but still benefit from some of the knowledge sharing that can move these projects along. And if you look at it, overall, there is a huge shared benefit that we're all trying to achieve. Whether you're an off-taker, a project developer, a supply chain player, a financier, we're ultimately all trying to bring this industry into beam. And all of us are going to play a role to make it happen. So the kind of, if you like, the potential conflicts of interest and issues, they can be managed, but there's a huge benefit to be unlocked by bringing all these parties together.
And maybe that's a good segue into talking about the projects themselves. So we have 7, as we mentioned. We have 5 in Queensland, 1 in Western Australia, 1 in New South Wales. And between them, we have hydrothermal liquefaction, pyrolysis, gasification, ethanol to jet, cellulosic ethanol, and a blending and refining facility for waste feedstocks. What were we selecting for when we brought this initial cohort on?
Well, this is a pilot exercise. So we wanted to have a set of projects that represented not only different regions of Australia, but different technology pathways and different stages of development. And this was all for the purpose of trying to understand how this Green Fuels Accelerator can add value to projects from very different contexts. And that's really at the heart of testing this model. So if you look at our cohort, we've got projects with really innovative new technologies like Renergy, which is in Western Australia doing grinding pyrolysis, which is converting waste streams into bio-oil of biochar. We have the likes of Mercurius biorefining, which is using its own conversion technology for lignocellulosic biomass as a drop-in fuel. You've got Wildfire Energy, which has been in the news lately because it's just closed a recent capital round. And that has its own moving injection horizontal gasification that produces biomethanol in south. And you've got EthTech, which is in New South Wales, which is doing its own cellulosic ethanol a technology pilot. So these have got this range of really innovative technology solutions. And you've also got these really large scale commercial projects. The likes of Wagner, which has got a SAF blending terminal, large scale refinery, converting waste feedstocks. You've also got RDA, Renewable Developments Australia, which is in Charters Towers in Queensland, which is doing this ethanol to jet facility. And Licella, which has its own HTL technology, but also developing a large scale commercial plant. So we're really excited by this cohort of projects. And for us, it was really important to get a range of different projects with a range of different contexts for us to learn. How do we best help these projects depending on their context?
And this is a question we're getting a lot. Can we accept other projects into the program?
Yeah, look, we've had a range of projects emailing us and asking how do they get in the program. And look, unfortunately for this pilot, we don't have space for any more projects. However, the plan is to stand this up as a permanent organization. And then once we do that, we're going to be doing a broader call for entry into that next cohort, and we'll definitely advertise that broadly and hopefully support a much broader range of low carbon liquid fuel projects in Australia. So for the time being, for those that can't be in this pilot cohort, we do have those additional materials I talked about, the webinars, the knowledge sharing documents that we'll be generating that we hope to provide some form of benefit to those projects in the interim.
Perhaps we talk a little bit more at the nitty-gritty level of the financial readiness assessment, because I think that's a really core part of this program. Could you share a bit more about what it is and why a developer needs an external tool like this?
Yeah, so the Finance Readiness Assessment, or FRA, maybe we'll develop a kind of a more catchy acronym over time. So suggestions from our viewers very very much welcome. But it's a structured diagnostic that allows us to identify and prioritize what are the issues that matter from an investor standpoint. And this is really crucial because it basically tries to surface issues early when they're still inexpensive to address. The worst thing that can happen is a project progresses all this way. There's been lots of development capital, lots of effort, and then basically they come to a set of investor decisions where they realize that there's some really fatal underlying issues which either can't be rectified or too expensive to change. So we're trying to surface those issues early and help projects navigate and know how to deal with it.
And the FRA has 3 legs: a development progress index, an FID readiness index, and a transaction readiness index. What is the difference and why do we need all 3 of these?
We need all 3 because they tell us slightly different things. So the development progress index basically answers the question, have you done the work? So have you done the work across the different dimensions from offtake to financing to supply chains, etc., or where we would expect your project to be given that stage. And often we find that projects that say, oh, look, we're at feed stage or at pre-feed. We actually look at the different dimensions. Some of them are even more advanced. Some of them are actually a really nascent level. And that's really important to help shine a light on where we need to focus the activity. So that's the first leg, if you like. The second leg is around FID readiness, so the final investment decision readiness. And this is basically taking the perspective of those end debt and equity investors and say, how would they view this project? And in short, saying, that work that you've done in development progress, is that good enough? Is that good enough to satisfy the concerns of debt and equity investors? And then the third and final leg is around transaction readiness. And it's basically saying, can you take that work and bring it to market and get the capital you need? So sometimes what we see is that projects have done really good work on development progress, are pretty attractive from FID readiness. They don't necessarily have the right kind of materials or strategy ready to engage investors. They don't have the clear financial model. They don't have the IM and teaser documents that really speak to the concerns of investors. And having all 3, we believe is crucial to help unlocking capital. Often what we see is that projects can be strong in one of these dimensions and have some gaps in the other ones, and then get frustrated because they go, well, why can't we get the kind of capital momentum that we think we should have? And that's because you need all 3 to really get that momentum.
And the tools use the same 6 dimensions, which are offtake, financing, policy and regulatory, supply chain and operations, feedstock, and technology risk. Why are those 6 important?
The reason is that each of them is crucial to getting a financial close. So, in simple terms, offtake, is there reliable demand for this product? Policy and regulatory, is there a clear path both in your development but also in your offtake to navigate the various regulations? In supply chain, is there a credible set of experienced contractors who ensure that the project can be stood up? In feedstock, can you get reliable access to feedstock for the next 30 years? This could be up to 50% of your project costs. And as we know in Australia, in drought conditions, your feedstock requirements can look very, very different. What's the insurance mechanism for that? Technology, does the technology stack up at scale? we've got a lot of promising technologies that have done at pilot level, sometimes at demonstration. But what happens when you scale that up, 200, 300 times? Does it still function as it should? And then financing, is there a blend of debt and equity investors who are willing to provide money for this project given the risks? And so all of those 6 elements are really, really crucial. And what our diagnostic does is it dives into the weeds in each of them and really tears each of them apart. So there's close to 60 indicators across there that we really delve into to understand each of those different dimensions and where a project sits.
And how does a project get scored, and who fills it in?
We do it in 2 ways. We have a self-assessment, so get the projects themselves to actually complete that and give a view of where they're at. And then we have our external assessment done by our team and our experts. And that's based on the materials provided, the IMs, the financial models, etc. And we find that both are really crucial to understand where's the project at and where potential blind spots are. So, a project may think that they're actually at this level, but, we actually may see that actually, they could be slightly behind that level. And that's really important information for them to have now. So they can then do work on that to help correct. And it's really important that all our information is confidential. So we don't share this with anyone else. It's just for the benefit of the project, so they can use that to improve their own development progress, taking on board some of that feedback.
And as part of that scoring, we have a really strong emphasis on evidence. So our framing is that a rating reflects not just whether a position is strong, but whether it can also be substantiated to an investor standard. Could you say a bit more about that?
Yeah, look, we deliberately take the perspective of an investor. So an investor's always going to say, what's the documentation? What's the proof that goes with that? So, for example, a developer who says that they've got a feedstock secure, but that's based on a handshake and as an email exchange, is not going to stack up versus a contract that goes through all the detailed clauses that would be expected, understands force majeure and all those other factors that could influence this contract. So that's the kind of detailed evidence we look for, is how would an investor see this project? What's that level of evidence that a project would need to give to satisfy them?
And then finally, we wrap it all up and do an overall assessment. Can the overall assessment tell different stories?
They really can. Those 3 legs of the stool are really crucial. The development progress tells us how far your project has traveled on that development cycle. The FID readiness tells us how solid is the ground underneath it. And then the transaction readiness tells us whether you can convert that position into money. And because a project can score well on one and badly on another, each of them can lead to a different set of interventions. And we think it's really important to have that holistic understanding.
Let's move to talking about success. What does success look like for us and for the projects, and maybe starting with the projects? So for them, what would success look like over the course of this work and beyond?
Look, our overall goal is to improve the probability and speed at which projects reach financial close. Now, we have to be mindful of the fact that this is a limited duration. So we have 8 months for this. It is unrealistic that, given a 4-year development cycle, that we're going to see these projects all the way through to financial close. But what we do hope is that within the time period that we have as a pilot, we can give the right kind of tools, advice, and guidance that helps create that momentum for these projects to then go on to hit financial close, as at faster speed and with greater probability. And that's everything that we're trying to do, is compress that timeline. One way to think about this is that every project roughly across green industry talks about a 4-year, often 3 to 4 year development cycle at best before they hope to hit financial close. We don't have the data on this, but what we've seen in practice, it's extremely rare for a project to actually hit those timescales. Effectively, what happens is a project gets a bit of momentum and then it gets stuck. And it gets stuck and it spends most of its time trying to fundraise. And then finally gets going again. And that turns like a 3 to 4 year cycle into a 10-year cycle. And this is obviously really a challenge, because the project sometimes won't have enough capital to maintain that, or just or dogged perseverance. It also matters from Australia's position, if we want to be a leader in this field and first to market. And also, of course, from a climate perspective, as we know that every additional year of delay has a really significant impact on the climate. So these delays are really crucial. And anything that we can do to unpick that and make it a much more efficient process we believe will be an incredible area of value.
We've talked about how this is a pilot program, so we would obviously like to see this continue with additional cohorts and to other sectors. But what is the long-term funding for the program? What are we thinking?
As I mentioned earlier, that this current part's been funded by ARENA with significant in-kind contributions from ourselves and our various partners. And we're very thankful for this. But one of the tasks that we will be looking at during this pilot is how do we set up the long-term funding model? And we're looking at a range of different options of whether that's kind of membership type models, whether that's linked to some kind of investment fund, etc. So stay tuned, and that's the kind of exploration that we'll be doing over the course of this pilot.
And I've alluded to the answer already, but does this stay with liquid fuels? I mean, the pilot is very much sector specific for reasons we talked about earlier, but the theory of change is meant to be replicable, right?
Yeah, exactly. Not at all. This part can deliberately be taken across different sectors, first of a kind sectors, because we see the same kind of issues. And all the tools that we're developing, the finance readiness assessment I talked about earlier, is something that we can easily adapt to other sectors. And we think this is really crucial because if we can get these replicable toolkits, it makes it a lot easier to take the learnings from this to then apply, whether it's green ammonia or green iron, and help fast track the development of those areas as well.
And fast forward 10 years, what does Australia's fuel landscape look like if this works well?
Look, I guess I'd like to see some real meaningful progress in 3 key areas. First of all, fuel security. Like it would be an absolute shame that in 10 years, if another fuel crisis comes along, like we're seeing now, that we're in a situation where we're so vulnerable with 90% of our fuel imported. So I would like to see in 10 years' time that we really are on a pathway to our own domestic fuel security. And to be very clear, that can't be done through just increasing our storage tanks. That's an expensive and really time-bound mechanism. But being able to have a really well-developed domestic industry that is not only providing export benefits, but is also safeguarding our own fuel security is area number 1. Area number 2 for me is that, I want to see Australian leading companies at the forefront of green fuels. It's why I co-founded Suncable. It's my motivation is that we are sitting on an absolute goldmine of potential. How do we translate that gold mine into reality? That's the key. So I would really love to see a whole range of Australian companies which are becoming the new household names, the new BHPs, the new sort of standard bearers for Australian corporate leadership globally. And then finally, from a social benefit standpoint, if we do this right, we should be seeing really important benefits to regional communities and to consumers. And I'd love to see, some regional areas which are really being transformed in a positive way through these partnerships of benefiting from these low carbon fuels. When we remember that, ultimately our competitiveness in this area is all about feedstocks. And those feedstocks all depend on our agricultural expertise. This is a really tremendous opportunity for us to reinvigorate Australian rural communities and make sure the benefits are truly shared. So that's what I'd like to see. 10 years of fuel security, a whole set of Australian leading companies at the forefront globally, and really tangible benefits of social benefits. So no, not much to ask.
Not much to ask at all. But you painted a really exciting picture of the future for Australia, and we should be competing hard to make that a reality. It's very exciting. Fraser, thank you so much for talking me through the GFA. Is there anything else that you want to mention or share with our listeners that we haven't covered?
Well, thanks, Joy, for the time to share this. I would just close by saying we're always looking to bring in additional partners. This is not meant to be a closed ecosystem. and that we know that to get this right, we're going to have a range of expertise that we don't have access to ourselves. So anyone listening to this who thinks that they can play a role, please do contact us, and would love you to be part of this venture.
Well, that's it for this episode of Before It Scales. If you enjoyed it, subscribe on Apple Podcasts, Spotify, or wherever you listen, and sign up to our newsletter at cyanventures.com for episode clips and show notes. And of course, look out for the webinar of the GFA coming out next week. That'll be the 27th of August, I believe. I will put the links to that in the show notes. We'll see you soon. Before It Scales.